It feels like really hot here, so it feels like a new season already. I don't like it.
It is warmer. I actually slipped on some cutoffs today.
I don't like it. I kind of want winter to stay a little longer.
Uh, it was nice.
81. It's 81 here right now.
81. Oh, gosh, I don't think we're anywhere near that here. Let's see.
It feels like summer.
Let me just check. Yeah, we're 70 here. Yeah, but I'm up in the mountains.
Yeah,
Also,
80 it feels like summer. 81 is too hot for February, I think.
yeah. Well, it is early in the season. It is still February. That is pretty warm. Well, we got a lot to cover today. You ready to get going? We talked about last time we talked about some scenarios of some good trust deed investments, and today I think we're gonna talk about. I don't think about it. We're gonna talk about maximizing returns on trust deed investments. And to be honest with you, um, when I went through the outline that I had created before, um, there were some things that I wasn't familiar with. So I've been doing some homework today, and I found out some new information or just some information that I didn't understand how this layout is outline match that information, but I have it now, so it's going to be
Oh, I
interesting.
thought you put this together. It's a curriculum?
Sorry,
Is this a curriculum or I thought you put this like
I did, but I put it. I used the large language models to do it. I used help to lay it out, so to organize it, and then they're not super good at doing the whole thing for you. It's just not the snap of a finger. You have to go back in and go, okay, look, I want this particular topic. I want more detail, or kind of have to back and forth it a little bit. So, um, yeah, I did I did the topics that I wanted to cover, but I had it help me write the bullet points and put it out. I'm not a great typist, so I'll take advantage of any tool that'll save me a few minutes. So, yeah, so I hope that answers that. Another thing that I checked into on that matter with regard to that was, what did you ask me? You asked me about um, investing when you're not an accredited investor. Remember
Mm.
that question?
I remember asking, I don't remember what the question was. I think it was,
We talked about it.
what's the difference on your end with working with accredited or non-accredited investors?
And then I sent you the form to show you that what I had to fill out and turn into the state.
Mhm.
Remember that form?
Yeah, yeah, I couldn't pull it up again
It's
because it was
okay.
in the
I
chat,
just
but
I asked the large language models, I asked them if they, what was the, if you're not accredited, what's available, for you to invest in.
really limited.
It is pretty limited.
It makes sense to me. Obviously, the more money you have, the more opportunities there are. I was just wondering, because usually I see people with it's usually with some type of a crowdfunding thing, and I assume that it was more paperwork or maybe more liability or something on whoever the operator is. I was just
Mhm.
wondering.
Yeah, the person who's putting it together, the
Yeah,
syndication. Yeah,
yeah.
and depends. Those are all different. They're all over the place too. So you could have a syndication where they give you a participation, not only in the interest, but what you're hoping to find if you're looking into those kinds of deals is something that returns you. Let's say it's on real estate, not on a note, but let's say it's on real estate. You want to get that depreciation passed through to you, and the passive income, and get the depreciation right off. So that's something we're going to go into a little bit today about the notes and try to maximize your profits. So that's kind of our focus today is maximizing your returns Can you see in the chat box a link that I put up, or is it only show you if you're here in the room already?
I don't see anything in the chat box right now.
Let me put it in there again. So this is a link to my notes for today. So this is everything we're going to talk about. So that's there for you. And so we'll go through that. So today we're going to work on maximizing returns on your trust deed investments. And we talked about those real world scenarios last time. And so we're going to look at some strategies to enhance our returns and cover some reinvesting earnings, tax advantages, refinancing, selling notes, and some practical exercises. So that's what we're going to do today. So one of the first things is, which was interesting to me, is the topic is reinvesting your earnings. You know, using compounding to maximize your returns. And so that's kind of one of the kind of basic, you know, investing 101 ideas is when you earn interest, leave it in there and have your interest earn interest on, you know, on its interest so that it grows faster. So for example, if you put in 10,000 bucks at 8% and you withdrew your earnings every year, at the end of 10 years, you would have your initial 10,000 investment and then $8,000 more. But if you used a reinvesting strategy and you invested your profits every year at the end of 10 years on a $10,000 investment, you'd have $21,589. So by compounding your investments, you get an additional gain in that particular scenario of $3,589 extra by leaving the interest in there and letting it compound on itself, interest on interest. Does that make sense? Yeah, so most everybody knows about that. You know, that's a pretty basic one. So there's different methods of reinvestment. And so let's talk about those for a minute. So you can do what's called a rollover return. So let's say your investment pays off and then you reinvest into a new trust deed opportunity. There's three ways to do that. Direct investment is just without any leverage. So you receive $50,000 from a note payoff and you directly reinvest the $50,000 into a new trust deed. Your returns will be based solely on your $50,000 investment, right? Common sense. Another strategy, which I haven't seen done, and I'm not sure that it makes a whole bunch of sense, but I've heard about it, is using leverage through a loan. So you get your $50,000 back and you go borrow another $50,000. Let's say it's at 8% or 7%, and you loan the 100 total out at 10%. You've got a little spread that you're making on your 50,000 that you borrowed, plus you're making the amount on the 50. So that's a leverage strategy. I think some people call that now, I think the kids are calling it arbitrage, you know, where you're using other people's assets to get a spread between the two and make some extra money. And then the third way of doing a reinvestment would be through a partnership or syndication, which we were just talking about, where you either pool your money with other investors and you earn prorated investments in relationship to your investment. Usually if somebody wanted to make money on, let's say you put up 50,000 and you had 5 friends put up 50,000, so you have a total of 300,000. You could, you can't do this without a license, but it's a strategy that you can use as a partnership or syndication with the right licensing. You can charge them a rate to manage it. So let's say the rate that you're going to pay them is 8, but the borrower pays you 10. So you take 0.5% for the servicing company, and you keep 1.5% as a yield spread for yourself. So you make a little bit of money, 1.5% on your friend's $250,000. So that's another way to invest, and that's what brokers do. We take a little piece of other people's money for managing it. So, um, but yeah, you typically cannot earn returns on other people's money unless you're borrowing it and to make repayment, or you're managing a fund or investment pool and earning a fee or a profit split. And with those, you have to have licenses or documentation. So another thing that you want to kind of watch out for, or want to make sure to maximize your returns, is some diversification strategies. Did you have any other questions on other thing before I move on?
No, but what the arbitrage that you were talking about, is
Yeah,
that
arbitrage. Yeah,
that that seems a little bit more risky, but maybe not.
it. Yeah, it can be. It can be. That's why I've never heard of it much. I mean, I've heard of it, but I've never ever watched somebody do it or been around anybody who played that, other than the brokers themselves, who are, we have the borrower and we have the lender, and we're putting everybody together, and we do it that way. But borrowing money to do it, I've seen it, heard about it, but I haven't done it. Seems super sketchy, because if a borrower doesn't pay, then you have to make that payment. Are you prepared to make the payment on the loan? In addition to what you're doing in your life right now, if you borrowed that money, because you can't stop paying, right? You have to make it. So yeah, it's super risky. So that I don't know that that's a great idea. I wouldn't, as a in a conservative place, I wouldn't do that. But it depends. I mean, if somebody's handing me money at 4%, it's essentially what the banks do. They borrow from the Federal Reserve at 4%, 5%. You'll see the Fed rate, and then you go down to the bank and you want to borrow money and it's 7. That spread is what they're getting. So it's done through a lot of different companies do it that way. But I think it's hard to do as an individual. And like I said, I haven't seen it done, but I've heard people talk about it. I think they were kind of people who talked about a lot of baloney type stuff. They didn't always, you know, didn't always tell the truth, or
I
they
mean,
exaggerated.
if the banks are doing it, then I guess it makes sense. You just have to be really smart about it.
Well, and look at what the banks make you do to get their money, to get them in that position. They're very, very uh, picky and thorough. And usually, what they do, they even do something else entirely different. There are some community banks that will hold the money locally and invest in the region, or little regional banks. But a lot of the home loans and that kind of stuff, those are automatically sold off as soon as they're funded. They sell it into the secondary market and get all their money back. So they'll make a yield spread premium for buying a note or creating a note, selling the note. They'll make a premium on it, and then they'll also, if they keep the servicing, they'll collect uh, money for servicing the note during the time. A lot of times they don't do it though. The smaller banks just sell it off. Some of the bigger ones like Wells Fargo and those guys, they have their own servicing departments. That's interesting. So let's go into diversification. So diversification, kind of, easy thing to understand. You want to spread your investments across different types of assets, markets, durations to reduce your risk and improve the stability of your returns. So in the context of trust deed investing, diversification helps to protect against losses if one investment underperforms or experiences delays. So let's break down those parts. So diversifying could be by property type. So you could do residential notes secured by single family homes, multifamily properties, or rental properties. You can do commercial notes backed by commercial real estate such as office buildings, retail spaces, or industrial properties. Or thirdly, you can do land notes, which the investments are secured by undeveloped land or lots, often with the potential for development or appreciation. So the example of that is, let's say you have 300 grand to invest, you do 100 grand in each one of those categories. Maybe your residential trust deed is 12 months, your commercial trust deed is 24 months, and your land development note is a 36-month term. So you've got yourself spread out in type, time, and hopefully there's some other things we'll go into here in a minute. So investing by duration, that kind of those last three gave duration. So the short-term notes typically involve bridge loans or construction loans with 6 to 12 months timeline. These offer quicker returns and liquidity. And then the longer-term notes involve stable rental properties or commercial investments with terms of 2 to 5 years, providing consistent cash flow. So it's pretty common in commercial properties for them to have a 2 to 5 year balloon on their mortgages. You wouldn't think so, but it's really common. Are you familiar with that?
A balloon payment?
Yeah. The banks will only loan them for up to 5 years. 2 to 5 years is as long as they get 24 months, they borrow the money. And then they've got to renegotiate their loan. So it's in commercial notes.
With the same bank or with a different lender?
It's usually with the same bank. They just renegotiate it. So what happens with commercial is it's more volatile. So the banks want to be more protected. So as trustee investors, so would we. So we want a shorter term, or if we use that amount of time for that kind of note, we don't ever want to go past 5 years. There are some out there that are government backed that go to 10 and 15 years, but we're too small to take that kind of a hit and that kind of a time frame. So within 2 to 5 years, like in the last, we had pretty stable rates for a long time, from 2008 until, a couple of years ago. But that's not normal. In my lifetime, I'm used to seeing things right around 6 to 9 years. The rates go up and down pretty good every 6 to 9 years. So by doing it in 2 to 5 years, you're able to reset your interest so that you're always at market, so you're not, being underpaid. And that's what we're trying to do, is maximize our returns here. So nothing hurts worse than to have a loan out at 4% and the market's at 10, and you can't get the loan called off, paid, and get your money back and get into 10% money. So nothing's worse than that. So hey, it's okay. Whoever it is, they're not breaking in. And then of course with the construction loans, we only want those, or the bridge loans. Those are only going to be 6 to 12 months anyway. I mean, those are nice and short. Another way to mitigate your risk is by geographic location. So you want to do across different regions or markets to mitigate, the impact of local economic downturns. Even today we're seeing the talk is, you follow the U-Haul trucks report. Where are people moving to? And where are they moving away from? And so that's a big deal. Where people are moving to is where you want to invest your money. You don't want to find a spot where they're moving away from to protect yourself. And that's one of the diversification things that works really good. So why does this diversification work? Well, it's a form of risk management. So if one of the investment faces delays or defaults, the others continue to generate returns. And that's, to me, that's kind of what I like to see too. Like I'm interested in multifamily apartments. I'm interested in RV parks and mobile home parks because you can have 2 or 3 or 4 or 5, 6 people move out. It doesn't affect your investment. So I kind of like having things in multiple pots or having multiple income streams coming from the properties. Opportunity flexibility. So the different types of investments perform well in different market conditions. So what that's going to do is you're going to learn, if you do this, do different opportunities in different markets and different diversification, you're going to learn how to pick better markets and how to, over time, you're going to get better at choosing which places you want to put your money in and under what conditions those, makes it good sense for you to invest in that one area. For instance, residential markets might be strong even if commercial real estate slows down. And the cash flow balance, short-term investments provide quick liquidity while the long-term investments build wealth steadily. So there's another thing that is important in this diversification is timing considerations. So evaluating market conditions. This involves assessing the current real estate market and the economic environment to determine the optimal timing for reinvesting in trust deed opportunities. A well-timed investment can significantly enhance the returns and reduce the risk. So the obvious question is, when's the best time to reinvest, right? So good indicators would be when borrowing costs are low, it can create some opportunities for some higher margin trust deed investments. Like for example, we are looking at a lack of housing inventory and the interest rates are higher now. And there's a push to lower those interest rates. If they get lowered, there's going to be a building boom. And in the building boom, there's going to be a need for short-term money from private notes. And so that'll be an opportunity to grab 8 to 10 to 12% on construction loan money with your investments. And those will be, usually in a growing market because that's where they're going to build. And, it's a newer property, so the collateral is nice. You're not going to have any problems for 5 years or whatever, but, it's just a good deal. When there's high demand for real estate, if the market's really strong, especially in growing regions, this often means that it's safer and potentially higher returns are available on trust deeds. And like everything, higher demand, higher price. Another thing that you want to look for is the stability of the market. Look for a stable or appreciating markets where the values support the security of the note. So you don't want to buy, like in Florida, the last 12 months, the prices have just tanked on houses in Florida. They've just gone.
Really?
But, sorry?
Really? Why?
Well, because the interest rates went up and they have everybody moved there. And so when everybody was moving there from the COVID thing, the prices went above what they should have gone and everybody bought in. and they bought in at higher rates than they should have, and now when they want to sell, they can't get anybody to buy it. The prices have come down. The demand is not there anymore, so that market is getting crushed. So you have to be really careful if you're going to invest in Florida right now with the values. So look for stability in the market. See if it's people moving in or moving out. Um, people were moving in, and that was great to get in. Short term. You wouldn't want to do long term there. And all of the stuff that we do, at least that I do, I'm interested in the short term. There are people out there that they want to put their money in somebody's property, and they just want to receive the payments every month for 30 years. I don't know if that's you, but um,
That
that's
kind of was me. That's why I wanted to do the residential notes,
yeah,
because
30
you
years
just
without a
do one, like, research due diligence one time, and if it's good, then you don't have to keep doing it every 2-3 years. So that's one mindset that
yeah.
I have, but
Did
there's
I?
also downsides for that too.
Yeah, and there's nothing wrong with that. Did I blow your mind when I told you that the average person moves in 8 years? I told you that. I remember telling you that. So with this idea, if you're going to go for the 30-year, but the average person moves in 8, it's possible that you get somebody who pays the full 30, but it's also possible that they move out in 8 years and you've got to replace your money somewhere else. So that's something to look at. Check the averages, how long the average person stays in the home. And then there might be some indicators out there that might indicate that someone would stay longer. Let's say they were born in the community, they went to high school there, graduated there, went to the community college there. That person might be someone who hangs out. It seems like to me, a lot of the people that I went through high school and college with are no longer in the hometown. I'm not. So everybody kind of moves around a little bit, I guess, looking for their jobs. Um, I guess the next thing we were talking about stability, and we went into Florida about buyer and seller market cycles. When it's a buyer's market, property prices are low, and you can secure trust deeds with strong equity cushions. So if the prices are low, why would it have an equity cushion? They're likely to appreciate, right? So that gives you more equity as they go up in value. You're not raising your loan, so you're getting a bigger equity cushion. In the seller market, potential higher returns are if the borrower is leveraging increased property values. What in the heck does that mean? Potentially higher returns if the borrower is leveraging increased property values. Seller's market. Oh, I see. They're taking their money out and leveraging up to another unit, and they want to borrow some additional funds, maybe a bridge loan or something like that. All right, so how to analyze the market cycles, understanding the market phases. So there's expansion, peak, contraction, and recovery, right? Every cycle does that, right? Expansion, peak, contraction, recovery, over and over and over. So increasing property values, strong demand, and good opportunities for new trust deed investments are on the expansion, the upward rise. The peak, the high prices, but caution is needed as a market correction may follow. Now, right now, what you're seeing in the stock market is who's our favorite stock market guy? He's put all his money on the sidelines. Why does his name slip me right now? Um, the fellow from Omaha, Nebraska. He's got billions of dollars on the sidelines, and several other investors have taken their money out of the stock market. I think they're thinking that we're at a peak. A contraction is the falling property values, and there's a reduced demand. posing a higher risk for trustee investments. So as the property values are going down, if you have a note secured by a deed of trust, your equity is shrinking. The protection is shrinking when values are going down. So contraction, a market that's contracting is not somewhere you want to put your money. So we want to make sure we understand those markets. In the recovery stage, the prices are stabilizing and they begin to rise. And that is an opportunity to reinvest, but you should be cautious because it's hard to see the bottom until you're off of it a bit. So be careful for that. Property values and trends. There are some key metrics to evaluate here. One of them is property values and trends. And the tools that you can use that are available to the public are Zillow, Redfin, or MLS data. So you can track appreciation and depreciation trends. You can get rental market data if you're investing in notes backed by rental properties that ensure rent prices are stable or rising. You can usually get that through property managers. And I think there's some other companies out there that provide that data. What is it? Rentometer? Heard of Rentometer? Yeah. That should have some. They have a lot of data on that site. I think you have to pay for a membership to get at some of that. Look at economic indicators. Look at local, excuse me, local employment rates, population growth, and economic development. So, if the employment rates are high, population is not growing, and there's no new businesses coming to the area, probably a no, right? But if it's the opposite, they can't get enough people there to work. The jobs, like people commute around the country. Well, there's jobs in Houston. Everybody takes off for Houston, right? So if they're looking for people, population growth, and the oil boom's going or whatever's going, like in Austin, they're going crazy with the SpaceX thing. And then another thing that you can check into is real estate transaction volume. So a high volume of sales often indicates a healthy market. So where are sales right now in California? Do you know? So they're off a bit. They're up for the season, but they're off of last year's numbers right now. So we're down a little bit. I think it's 3.6% off of last year's new houses for sale. So the volumes decreased year over year. So that's something to watch for. Now that's statewide. If you go into specific markets, it changes for each market. So you could pick, I don't know. I don't know of anywhere that's growing crazy. Well, I do. So Folsom, California, or Roseville, California, they're growing bananas right now. So those two cities would be a good place where there's a high volume in sales and a healthy market. But other parts in California are not so much. Let's see here. Let's talk about a practical example. So you get $50,000 from a note payoff. It's the residential market in your area is peaking, but the commercial market is in recovery. Instead of reinvesting in high-priced residential notes, you find an opportunity in a commercial trust deed offering higher yields with lower relative risk. So this is our example. You can check this commercial property, get market reports from CoreLogic, CBRE, or the National Association of Realtors. You can get some local market insights and network with local real estate professionals that are commercial brokers. You can do an economic evaluation by monitoring federal or local economic reports and trends that might impact real estate values. So if this is the case, 50 grand, and the residential market is peaking, I think that's going to push you towards commercial. And it looks like they're at the lower end of the relative risks. So what did it say? Oh, they're in recovery mode. So that means they're on the way up, right? So that'd be the place to put your money because you're going to have appreciation in that particular scenario. So here's the key takeaway. It says the best time to invest is when the market conditions align with your investment goals and risk tolerance. Yeah, that makes sense. Evaluating market cycles helps you avoid overpaying for deals and positions you to take advantage of opportunities when the market is in a favorable phase. Do you think after today you kind of have a little bit more of an idea of the market phase and what how to find yourself the best deal for what you're looking for? Is that, we kind of talked about that. Is that, do you feel a little better about that?
Good. I feel like I'm just learning about commercial, so commercial is still kind of new to me.
Oh, that makes sense.
Yeah.
Oh, that makes sense. Yeah, it's a little bit different of an animal,
Mhm.
but it's also, to me, it's much more comforting because it doesn't have. Are you familiar with who is that? Ben Shapiro? Do you know who Ben Shapiro is from LA? You know,
Mhm.
he says feelings
He's
don't.
not he's not in LA anymore.
Well, where he's in Florida now, right? Or Texas, somewhere he's gone.
I think
But
Tennessee or something.
yeah, he's but he says the facts don't care about your feelings.
Yeah.
Well, that's, to me, that's kind of the gist of it. Like, there's more feelings in the residential market, and the commercial market is just math. These are the numbers. This is net operating income. This is what it's worth. If it's a mom and pop operation, it's not going to have a good cap rate as if it's a, one that where you can do an investor hands off. So kind of that kind of a deal. All right, so you're ready for tax advantages?
Yeah.
Let's talk about that. So one of the key advantages of investing in trustees is the potential for favorable tax treatment. So understanding how these benefits can enhance your overall returns and reduce your tax liability. So the passive income treatment, are you familiar with that?
What was it?
The passive income treatment. So interest payments from trustees are typically considered passive income. So passive income avoids self-employment taxes. It saves you 15.3% on your income. So if you do a construction, let's say you buy a lot and build a building, you're doing not a passive income, you're actively involved in that income. So you have self-employment tax on it of 15.3%. So that goes away with investing in trustees. So you don't get that tax. Passive income can also be offset by passive losses, such as depreciation from other real estate investments, including which reduces your taxable income. So this is what we kind of touched on when we first started talking today, was this depreciation and investing in other real estate investments. And the trick for this is they both have to be passive income and passive losses. It can't be active income. You can't go and buy a rental and take your depreciation from a rental that you operate and collect the rent and take a deduction for your depreciation off your passive income from your notes. You can't mix those two. It's passive income, passive depreciation, active income, active depreciation. Does that make sense?
Kind of. I need a new tax person, so.
Okay. So with your taxes, if you there's okay, but well, let's break that down a little bit. Let's go behind the scenes a little bit like that. So if you're working as an employee, you are being paid a salary, right? A wage. So the person working as an employee has the highest taxes of all the people. So an employee gets the FUTA tax, Social Security tax, all these different taxes. Employer matches the taxes. they get the worst deductions, they get the worst everything, right? They have just a flat deduction now. They try to itemize it. It's rotten. It's the worst tax bracket of all. That's active income as a wage earner. The next choice is, let's say you want to be self-employed, you want to run your own business. So now you're going to have a self-employment tax that's 15.3% plus 15.3% because you have to put up your taxes for the government, the FUTA and Social Security, those taxes, and then you've got to deal with all that. So they're the next highest tax group, but there's some benefits for them by being self-employed and creating a job for themselves or possibly for others. They get to pay taxes after expenses, where the first group on salary, they can't invest, they can't take any of their money and deduct any expenses from their income. Maybe there's a little things like, but it's never enough to, it seems like it might be in some of the higher income brackets, but you know, the straight deduction is always seems to be more than what you can write off for a salaried person. And the benefit of self-employed is, let's say they run their business and they need gas to run their business and they need electricity and they need phones, and so all those expenses come off of their income. So if they make $100,000, you deduct all those things, they have $50,000 left. So their taxes are based on their profit that's left over, and they pay that. The next group is business owners, people who own the business, but they passively operate the business. They, as a matter of being passive, they pay even less tax. They don't have this self-employment tax. And then the final category is people like investing in trust deeds. That's completely passive. So you get the least amount of tax against you for investing passively. Why is that? Why is it kind of laid out this way? Well, the government wants those who save and who have money to invest that money back into society, so they give them the best deal. And that's why it's broke down that way. You'll hear on the TV all the time, they say, so-and-so doesn't pay any income taxes. Well, there's only one category that pays, or two categories actually, that pay an income tax. The salaried worker and the self-employed, that's a small business. The bigger corporations and stuff, they don't have an income. They have a corporate income tax, but the person who owns it just passively owns the shares. They have a passive tax. It's not an income tax. So you can use the nomenclature, you know, the words to say that they don't pay income tax. Well, that's true because the tax law doesn't ask them to. It asks them to pay, you know, capital gains tax. So it's always interesting to me that people say these things and they're completely different animals, and they take people's lack of knowledge and throw that out there and make it look like the rich people are not paying anything, but they are, sort of. I mean, the government charges them a different rate, but they're investing back into the society their money so that they can get that break. They have to take a risk. It's, you know, this is not unrisky type stuff. I mean, you know yourself, you're facing some challenges with, you know, getting your money back, right? So that's part of the benefit of why they get a lower rate in the government, is because they're risking their money, you know, for the benefit of themselves and the society. So the government kind of partners with them in that way and gives them a discount in their investments. So let's go on to the next section here, the passive income definition, which we've kind of just gone through. It's income generated from investments, rental properties, or other enterprises in which the investor is not actively involved in the day-to-day operations. Trust deed investments, or interest is earned from trust deeds, is generally considered passive. which may have tax advantage over active income, such as wages or business income. So the tax implications is passive income is not subject to self-employment tax, which saves you about 15.3% in taxes. What do you do with your savings of 15.3%? You reinvest it because it makes your money grow faster, right? You roll it over. We talked about that earlier. So it may be offset by passive losses, which we just talked about, such as depreciation from other real estate investments. But again, those investments have to be passive too. You cannot participate in the active operation of those real estate investments that have depreciation. So you may have your SDIRA invest in a piece of real estate that a property manager manages, and you never touch it, you never handle anything. It's all done through a third party, and that's all passive to you. And now you can take the depreciation on a passive income, a passive depreciation against your passive income to lower your taxes. So you'll want to check into that one. That one's a little complicated, but if you're going to do this, you're going to want to try and get some depreciational assets that you've invested in that are managed so that you can have basically get yourself down to zero taxes. The depreciation, by the way, to me, that's a little deceptive. The depreciation that you take and don't pay the taxes now, it's deferred. So, and the deferral can happen you have to pay those taxes later, and it can happen in two ways. And it can also, in one way, it can never be paid. You can skip the taxes entirely. So the one way that you have to pay it is you sell the property, and that becomes a taxable event, and all the depreciation is now thrown back into it, and you pay the taxes on it. If you want to skip the depreciation, what you do is when you die, you pass it on to your heirs through a trust. Gosh, why is it on the tip of my tongue? There's two types of trust. There's one where it's permanent, and one where you can rewrite it. So the rewriting one is the one that all of us do. You pass it on to your heirs, and then there's a tax exemption in the state and federal law that lets people not pay those taxes on the depreciation, and it resets the book value of the property for your heirs. So that's the only way to get out of those taxes, but you can do it. So it's a matter of learning all those steps and then actively getting all that done, putting that all together. Let's see here. What else do we have? Okay, so how to maximize your benefits with a self-directed IRA. So you know what those are. So self-directed IRA account allows you to invest in a broader range of assets, including trust deeds, real estate, private loans, beyond traditional stocks and bonds and mutual funds and all that. So types of self-directed IRAs are traditional one, which contributions may be tax deductible, and investment growth is tax deferred until withdrawal. The Roth contributions are made with after-tax dollars, but withdrawals in retirement are tax-free, including all the growth. So often you'll hear people recommend the Roth IRAs over the traditional ones because you pay your taxes now up front on the smaller amount of money, and the amount of money that grows, you don't pay taxes on it later, and you get to keep all of that. So two different ways of handling it. You'll have to work those.
Someone just told me that today to open up a Roth, and I was like, I'll look into it, but I didn't know the difference between traditional and Roth.
Oh, yeah, it's a big deal. You'll want to run the numbers. The traditional one, let's say you're doing it with.
I think the Advanta account I opened, I'm pretty sure it's traditional. I didn't even know I had an
choice.
option. Yeah.
They can't, I don't believe they can be switched between each other. You have
I
to,
think it was traditional because it was my old employer
yeah,
retired. So I
yeah,
think that's
yeah,
our before tax.
yeah. So that's fine. So in the future, anything that you do, if you know, take a look at the Roth. I did all mine as in my life, I did as the Roth, but I was self-employed my whole life. So I did them that way. And so I would do it with after-tax dollars. And it was different for me. So when I took it out, there was no tax on it. And I think the withdrawal age is 62 and a half. So, let's see here. This is supposedly how it works. Let's see what it says here. Invest in trustees earnings, invest your trustee earnings into the self-directed IRA. Interest earned on the trustee grows tax deferred in the traditional IRA or tax free in the Roth. So in the IRA, when you take it out, you'll pay tax. So you'll pay a bigger tax in the future. That's why the IRAs are not recommended, as opposed to the Roth, where you pay the tax now. Um, and then when using a Roth IRA, if held until retirement, all withdrawals, including your earnings, are tax-free. So that's kind of the cool thing. That's why I did mine that way. 401k, let's talk about those. What is that? So like a self-directed IRA, a self-directed 401k allows investment in a wide range of assets, including trust deeds. It can be set up as a solo 401k if you're self-employed, offering more control and higher contribution limits. Tax benefits, the tax deferred growth. Contributions are pre-tax and investments grow tax deferred until withdrawal begins, typically after 59 and a half. Tax-free withdrawals. If using a Roth 401k option, withdrawals in retirement are tax-free. So that's something you probably want to check into, that Roth word, and for what you're doing. You're young enough that you can make a modification in your future by doing that. How to structure deals. Purchase trustee direct notes directly through your 401k account. All interest payments are deposited into the 401k, avoiding immediate taxation. This strategy allows investments to compound without an annual tax drag. So that's that, and that's what we're doing with that Advana account. You're having everything deposited back in there, so you have no tax on it at the time. With a straight IRA, you'll get it on withdrawal. With a Roth IRA, there's no tax deduction. All right, so let's take a standard taxable account versus a tax advantage account example, and let's compare them. So let's say we earn $10,000 in interest annually from trustees. Assuming that we have a 20% tax rate, we pay $2,000 in taxes, keeping $8,000. If you have a self-directed IRA or 401k, you earn the same $10,000, but no immediate taxes are due. So your reinvestment is the full $10,000, allowing compounding to occur on a larger principal amount. The impact over 10 years with a standard account after taxes, $8,000 reinvested annually. A tax advantage account has a full $10,000 reinvested annually, leading to significant higher returns due to compounding without tax interruption. The key takeaway: passive income helps avoid self-retirement or self-employment taxes. Self-directed accounts provide powerful tools for deferring or eliminating taxes on investment gains. Using these accounts for trusted investments can accelerate your wealth building by maximizing your compounding. So let's go into a little bit more of the tax deferred accounts here. Self-directed IRA, tax deferred growth, taxes are due on withdrawal. We already went through this. Is this a duplication? Let me take a look here, see if I copied twice. No. Must be that we're just doing examples. In this case, you invested $50,000 in a trust deed at 10%. Through a Roth, you'd earn $5,000 annually, which grows tax-free, and you were able to withdraw all your principal and interest without taxes. 401k is the same deal. So let's go through the numbers real quick. Regular account, if you did a $10,000 annual return, after 10 years, you would have earned $125,233. With your self-directed IRA, after 10 years, you would have earned $144,865, which would give you an additional gain by using a self-directed IRA or Roth of $19,632 through your tax savings above the other money. So that's a big deal. You could use an extra 20 grand, right? Yeah. Yeah, going out to dinner and eat 20 bones, right?
Yeah, I could do a lot with 20 grand.
Couldn't you though? It's a lot. Yeah, it's a lot of money. Offsetting passive income with passive losses. Well, we talked about that a little bit. Passive losses come from rental properties, businesses. You could own a business and not have hands-on and have a passive loss, or in other income-generating activities where you're not materially participating. So earlier we were talking about passive depreciation and passive income. This is passive loss. So if you have a passive loss, that can be deducted from your passive income and give you a tax deduction. Depreciation is a non-cash expense that allows real estate investors to deduct the gradual wear and tear of property over time. Operating expenses are the maintenance, repairs, property management fees, and other costs associated with managing properties. And interest expenses, mortgage interest payments on investment properties. Those are all common sources of passive losses. So the IRS allows you to depreciate your residential properties for 27.5 years and commercial properties for 39 years. So if you own a property worth $275,000, excluding the land, you can deduct $10,000 annually as a depreciation expense. And then remember earlier I told you how to get out of paying that depreciation and you transfer that property. You can do a 1031 exchange is another way to do it, and that puts it off. But if you transfer it on death to your heirs, you'll never pay that tax. Let's see, what else? Impact on your taxes. If you come up with, on that particular scenario, if you're making $10,000 annually and your depreciation is $10,000, your taxes are reduced to zero. You also can, let's say your passive income is $10,000 and your passive loss was $12,000. You can take the $2,000 and move it on to the next year on your tax returns. So
What's an example of a passive loss?
the passive loss was depreciation, operating expenses, and interest expenses on a business or a real estate that you are not materially participating in operating.
So that means for operating expenses, if your operating expenses exceed your
Income.
revenue or income, then
Yeah, then you carry over the expenses to the next year. So maintenance, repairs, property management fees, and other costs associated with managing the rental properties are your operating expenses. Let's say you had to replace a roof on 25 of your rentals on one property, and it cost you, $2 million. That's a big chunk in 1 year. You can't take it all off of your income that year. So you're going to probably borrow the money for one. So your mortgage interest payments are going to be deductible as passive income loss, passive loss. and the repair that you made is a passive loss. But you can't take that all in 1 year, so you're going to have to spread it, you know, as you make money. That's just sitting there for you to zero out your tax liability. So it's the government wants you to be in business. They want you to take care of your properties. They want you to provide services. They want you to invest in the country. And for doing that, they give you deals on your taxes. They become your partner if you do it their way. So that's what we want to do here. If you're investing with this, you're going to get straight passive income, which is the lowest taxable income that you can get. But beyond that, we could also go into passive loss. And what was the other one? Passive, there's another one, passive loss, and help me out here.
So what was a passive question?
Oh, depreciation or something like that. I can't remember what it was.
Operating expense?
Yeah, those are all losses. Yeah. Okay, so let's go back to this here. Yeah, we already went over that. Lost my place. Okay, so here's some other deductions that you can write off as a trustee investor. So for your tax strategy, legal expenses, attorney fees for drafting documents, reviewing contracts, and handling legal disputes. That reduces your income. Appraisal costs, pay for property appraisals to assess collateral value. Management expenses, costs related to managing the investment, including servicing fees, administrative costs, and more. Interest expense, if you use a loan to finance the investment, the interest paid on that loan may be deductible. Travel expense, cost for visiting the property, attending meetings, or conducting due diligence. It says here you must keep a documentation of that. So you'll need a logbook for travel expenses. Accounting fees are deductible, expenses for professional tax preparation, and financial advice related to the investment. And then marketing costs, if you're actively managing and marketing and trust deed opportunities, those expenses may qualify. The depreciation benefits involve property acquisition. This is a rare bird, but there's a case that you're dealing with. You're going to have a property acquisition, it looks like, possibly. You're going to get the benefit of depreciation. How is that possible? Once the foreclosure happens, you can begin depreciating the property day one. As not before the foreclosure, but afterwards. So a depreciation applies on the property acquisition through foreclosure. For borrower defaults, you acquire the property, you can begin depreciating the property as a real estate investor. Investing in real estate-backed trust deeds in scenarios where the trust deed includes ownership rights or when structured through a real estate holding entity. So like a real estate investment trust. Or what's the other one? A partnership, real estate partnership. Those can be that way too, where you're not actively doing anything. You just own part of it, or a real estate investment quote. How depreciation works, we talked about that. Residential was 27.5 years. Commercial real estate was 39 years. And we talked about what the amounts were. So if you combine deductions and depreciation as part of your strategic tax planning, and if you acquire properties through foreclosure, apply depreciation to offset your passive income. So let's see what a real life scenario of that is. You earned interest of $20,000 from trust deeds. You had deductions of $5,000 in legal expense, appraisal, and management fees. The depreciation from a foreclosed property was $10,000. So your net taxable income on the $20,000 is $5,000, and 20% of that would mean your tax would be $1,000 that year, even though you made 20. So that's a good way to build and reinvest, build it and reinvest that money. So the key takeaway here is understanding the lower the taxable income, using deductions and depreciation. It'll improve your cash flow and it'll accelerate your wealth building using tax efficient investing. All right, so I have a couple of examples here. I think we already did this one. 19,632 is the gain by deferring your taxes. So let's move on to the next section here. I think that was a duplicate. When to refinance or sell your notes? It's a good question, right? I keep them the whole time. When do I get rid of them? What should I do? So refinancing a trust deed note involves renegotiating the terms of the loan, often to improve the interest rate or extend the term. So, and that's from the borrower's perspective. They want a lower rate or they want to change their term. This strategy can enhance returns and improve investments and overall performance. Possibly, if you extend the term, you're going to get more investment return. If you lower the rate, you're going to get less. But we'll go through that here in a minute. If they refinance and go somewhere else, you've lost your investment. Got to go find another one. Let's see here. So common refinancing strategies are to adjust the interest rate. So if we can increase the rate, if the market conditions improve, we can extend the loan, which will give you more time to pay and increase your interest income. Or releasing equity, if the property value has increased, you might refinance for a higher price, give them some cash out, and capture some of the property's appreciation. So those would be some scenarios where you might want to refinance. Some of the things that are important, you might want to refinance. A borrower might refinance. You might not want to in this scenario because we're trying to get the most we can. But borrower gets a better, the borrower's credit improves and they're at a higher rate due to low credit scores or high risk. Once they improve their credit scores, they're going to want to refinance for something lower. And sometimes if you want to maintain the note and keep it, it'd be a good time to say, okay, well, I'll take off 1% or 2% and refinance it that way and rewrite the note. I try not to do that. I try and stay in shorter notes and try and stay in higher demand notes so I can demand higher interest all the time. So, but like you said, if you were interested in the longer terms, that would be a choice you'd have to face at some point when the market goes up and down. When it goes down, they're going to call you. When it goes up, they're not. I want to refinance for a higher rate. They won't do it. So one of the ways people did do that, and it gets people in trouble, is the variable rate loans. The consumers are not very adept at flexing with the rates. Interest rate drop. Why does that matter? When the interest rates decline, new trust deed opportunities might offer lower returns. By refinancing existing notes, you might secure better terms without needing to find new investments. So let's say, for example, the rates go down, and you extend the term, you offer them a lower rate, but you don't give them any more money. So now your equity is, instead of 35%, say it's 55%. So you've got a better term in that scenario. This makes no sense to me at all. This is a strategy. If you hold a note at 8% and the market rate drops to 6%, you could refinance at 9%. Why? Offering a competitive rate to the borrower while boosting your return. I wouldn't do that as a borrower, would you? I think it's a silly example.
Get the typo.
I wouldn't do it. I wouldn't take it. No thanks. So the benefits of refinancing: increase your cash flow if you get higher interest rates. True. Protect your investment. Offering better terms might prevent the borrower from refinancing elsewhere and paying off the note early. Adapt to market conditions. Stay competitive without having to seek new trustee opportunities. Before refinancing, you should consider the cost involved. The legal fees, appraisal costs, administrative expenses might reduce the benefit. The risk assessment, ensure the borrower remains strong credit risk. Market analysis, compare potential returns from refinancing versus selling the note or investing in a new opportunity. Kind of have to check into that. Let's see here. Selling notes, when to sell. All right, so yeah, when to sell a note. This can be a strategic move to optimize your investment portfolio. Knowing when to sell is crucial to maximizing returns, reducing risk, or freeing up capital for new opportunities. This decision often depends on both market conditions and borrower circumstances. So let's see here. An increased risk with the borrower. If the trustee's investment security is directly tied to the borrower's ability to repay, it's absolutely number one in my business, the ability to repay. If that's not there, we don't make the loans. Indicators of increased risk: late payments, deteriorating credit score, or market value of the collateral is going down. A more attractive investment opportunity arises. If something else comes up that offers you a better return and better terms, that might be a time to sell the note that you have, because you can earn more somewhere else. So if you have a note at 8%, you might want to sell it because you know of a deal where you can get 12. Liquidity: sometimes there's a need for liquidity. You just have a personal financial need. You need to sell the note. Or the market timing. If you expect a downturn to come, gosh, what is that guy's name? I can't remember it still. He's thinking the market's going to turn down, so he's converting his note into cash to protect his capital. How to assess if the selling is the right choice: the current market or value of the note. Obtain a fair market value estimate from brokers or trustee marketplaces. Discount versus retained earnings. Consider if selling at a discount provides more value than holding the note until maturity. Does it align with your investment goals, with your overall strategy, whether prioritizing cash flow, capital preservation, or growth? The methods for selling are direct sell, note brokers, and marketplace platforms. An example: if you had a note that's $100,000 at 8% interest, you can get an offer from a buyer to buy it at $105,000, reflecting a premium due to the strong performance of the note and low risk. Net gain for you is $5,000, and then you can move that onto a higher yielding note. So you ever thought about that? You have a note at 8%, you sell it at $105,000, make yourself a little extra, and then invest that in something at 10 or 12%. So the key takeaways here are: risk exposure, if the borrower's situation or market weakens; opportunity cost, if the potential to earn better returns elsewhere; and liquidity, ensuring you have the flexibility to meet your financial goals. So those are examples of selling a note for a profit. How about where to find buyers for your notes? How about local real estate groups, investment clubs, professional networks, trustee marketplaces, investment forums, social media, existing investors, email campaigns? And then this one here is key strategies to maximize your return on sale. Offering a note for less than its remaining principal balance to offer to attract quick offers. That's when you're selling at a discount. When to use this if you need immediate liquidity, if the borrower's risk profile has increased, if a new or higher yield investment opportunity arises. Waiting for full value means holding the note until you find a buyer waiting, willing to pay full price. I got to sneeze again. If the note is performing well, and if you do not need immediate liquidity, if market conditions favor the seller, wait until you get the full price. Marketing to a trustee note to attract serious buyers. Marketing a trustee note to attract serious buyers. In details to include an investment summary, the principal amount, interest rate, and remaining term. The payment history, demonstrate consistent performance and borrowing reliability. Collateral information, the property type, market value, equity, and cushion, and equity cushion. The borrower profile, credit score, financial stability, and payment history. So what you want to highlight is strong collateral, good borrower performance, and the yield opportunities so that people will buy the note from you. Visuals, you can use property photos, charts of the payment history, and market comparables. And you can do clear financial projections to illustrate the expected returns for buyers if selling the note at a discount. Engage with buyers professionally, respond promptly to inquiries, be transparent about the note's history and potential risks, provide thorough documentation to build trust and facilitate a smooth transaction. So the idea in selling a trust deed is target the right buyers, structure the sale strategically, and market with clarity and professionalism.
Is that common to sell commercial notes? I feel like that's not very common
Sell the notes?
for commercial
It
notes.
happens all the time. I have some friends that all they do is buy and sell notes.
I know residential gets sold a lot, and that's how I got my note. But I thought commercial. Actually, one of the modules that when I took the test, that was actually one of the things they said that commercial loans are usually
Not
not.
that much.
Yeah.
Yeah, I haven't seen many, but that doesn't mean anything. you know, I don't know. When you're buying a commercial note, yeah, I don't know.
I'm sure it happens, but that wasn't one of the modules that commercial loans are usually held.
Well, there's not as many, and they also all the commercial loans have shorter calls than residential for the most part. I mean, 2 to 5 years. I mean, I don't know. It depends because there's a lot goes on in the market. I mean, there's a whole broad range of things. So let's say, for example, the seller carries a note and gives you a 30-year note on buying his industrial complex. He's probably not going to sell that note. He's going to sit there and collect that interest. Like you, he's happy to get his interest locked in for 30 years, right? So I would imagine under that scenario, they're not going to want to do it. I'm thinking of a few guys that they've done that. They'll buy a piece of real estate, renovate it, find a buyer, finance it themselves, and make we talked about it before, a wraparound mortgage. So their mortgage is 6%, and they sell it at 8 or 9%, and they get 3% off the total amount and do it that way. There's a bunch of different stuff you could do, but yeah, I don't know. I've been wrong before. It happened.
I go on some websites and some forums that where people are buying and selling notes, and it's very rare to see a business one a business loan or a commercial loan. It's usually some type of a residential house.
It probably makes a lot of sense from just the simple aspect of not as many people understand commercial.
Yeah,
Just the amount of people available to invest in that kind of thing, because it's more complicated, and there's no like, well, even in trust deed for houses is not.
I think it's because it's shorter. And then in that module, they did say that for commercial or business, it's more about the relationship. So you don't want to sell that relationship. Versus
That's
like
true. Yeah,
versus
true.
a residential, you just make sure you pay your mortgage so you stay in the home. But when it comes to businesses, you don't want to, once you find someone that you trust, you don't want to you don't want to sell that.
I see. Well, that's true. Yeah, it depends. Yeah, there's a lot of small businesses trading hands. It's interesting how they get traded. There's a lot of owner financing, a lot of that kind of stuff going on. Does that make sense? Well, let's see. Should we wrap up?
Yeah.
All right. So we talked about the importance of reinvesting for compounding returns. We talked about some tax strategies to boost our net returns. And we talked about when to refinance or sell to maximize our profits. There are some tools out there, some reinvestment planning software, some tax strategy guides, and there's plenty of self-directed IRA custodians, which you know about. So the next meeting, we're going to talk about current market trends and opportunities. So what do you think about that?
Are you gonna do the Advanta networking thing tomorrow?
I'm signed up for it, yeah, and I'm planning on it at 10 a.m. Are you going to be there?
I think it's 9. I think it,
9:30. It's at 9:30. You're right. No, yeah, 9:30.
I'm going to, oh, no, 9 to 10:30.
Uh-oh. Okay, I'm going to turn this off here. Turn off the record. Stop recording. Oh, okay.